In April 2026, Gevo announced its decision to withdraw its application for a loan guarantee from the U.S. Department of Energy, DOE. While the market might initially interpret this as a bearish signal for the stock price, I hold a different perspective. Gevo believes the DOE's restrictions are too cumbersome, such as mandating the integration of immature EOR, enhanced oil recovery technologies. Given its current asset profile, Gevo is fully capable of seeking more flexible, higher-yield financing in the private capital markets. This shift from seeking government aid to securing flexible capital, backed by robust operations, demonstrates strategic autonomy. 1. 2025. Financial performance, a quantum leap. 2025 was a watershed year for Gevo. Total annual revenue reached $161 million, an explosive growth of nearly 850% compared to approximately $17 million in 2024. Operating cash flow turned positive. In Q4 2025, the company achieved $20 million in positive operating cash flow, marking the first time in history Gevo proved its core business has self-sustaining capabilities. Significantly narrowed losses. Although net income remained negative, approximately minus $33.8 million, operating losses shrank drastically. Adjusted EBITDA, non-GAAP, reached $16 million, signaling that the business model is now fundamentally viable. 2. Sources and sustainability of earnings. This growth was not accidental, but driven by the successful integration of physical assets. Core driver. Primarily the acquisition and efficient operation of the Red Trail Energy low-carbon ethanol plant in North Dakota. The plant operated at 106% utilization in 2025, providing stable revenue from physical sales. Carbon credit monetization. The company generated $52 million in 2025 through the sale of production tax credits, PTCs. Sustainability. This revenue model is repeatable, with further capacity expansion in 2026 expected to reach 75 million gallons and steady contributions from the RNG, renewable natural gas segment. Gevo has set its 2026 adjusted EBITDA target at $400 million. 3. Policy tailwinds. Subsidies secured through 2029, Gevo's primary profit driver. The 45Z Clean Fuel Production Credit is explicitly extended through the end of 2029 under the current legal framework. This provides at least a 4-year policy dividend window. As long as Gevo maintains a low carbon intensity (CI) score through its technical advantages, it receives substantial subsidies per gallon. This safety net provides a valuable time window for technical upgrades without relying on external capital injections. 4. Balance sheet health, zero bankruptcy risk. Before 2029, the current financial standing is sufficient to weather future policy cycles. Debt restructuring. Complete. In February 2026, Gevo completed a $175 million debt restructuring, releasing $35 million in restricted cash. Ample liquidity. As of year-end 2025, the company held $117 million in cash and equivalents. Conclusion. Given that operating cash flow has turned positive and there are no major debt default risks for the next 3 years, the probability of bankruptcy before 2029 is extremely low. 5. Valuation. Comparison. EBITDA versus market cap. Latest market cap. Approximately $417 million to $420 million. EBITDA. Multiples. 2025. Adjusted EBITDA of $16 million represents an EV over EBITDA of approximately 26 times. Expected 2026 EBITDA of $40 million brings the forward multiple down to just approximately 10 times. Potential catalyst. Once the ATJ-30 jet fuel project, Project North Star, reaches final investment decision, FID, in 2026, it is expected to contribute $150 million in annual EBITDA. At that stage, the current $417 million market cap would look incredibly attractive relative to its earnings potential. 6. Product potential and platform advantage. Product: Sustainable Aviation Fuel, SAF. This is currently the only viable solution for decarbonizing the aviation industry. Gevo has locked in long-term contracts with giants like Delta and American Airlines in a market that remains severely undersupplied. Platform: the Verity Carbon Tracking Platform. This is Gevo's soft power. By using blockchain to track every carbon footprint from field to fuel tank, Gevo ensures its products qualify for the highest-tier carbon credits. This system could eventually be sold as a standalone service to the broader agricultural and energy sectors. Summary: Gevo has evolved from a high-risk visionary stock into a growth-oriented industrial stock with physical assets, positive cash flow, and policy protection through 2029. Risk warnings for small-cap stocks. Capex pressure. While the current plant is profitable, building the massive Net Zero 1 SAF facility requires hundreds of millions in investment. If private financing progress lags in a high-interest rate environment, or if construction faces overruns and delays, it will drag on the earnings timeline. The 2029 policy cliff. Current 45Z subsidies expire in 2029, while renewal is likely.